once a year in order to complete their tax filing, their requirements that are placed upon them by the federal government. It's very different in the rest of the region, and I think the President talked a little bit about the narrow tax base that you have here. It's exactly the same in other countries in this region. We have a mandatory provident fund system in Hong Kong, which forces people to save, similar, I guess, in structure, although it's held individually, similar in structure to the EPF, or at least the ethos is very similar. But it's been extremely difficult to get individuals to contribute to that system over and above the mandatory level. In fact, most companies have tried to find ways of avoiding making significant contributions to the mandatory system. They try to minimize their obligation. Most individuals are not making voluntary contributions under that system. Most people don't like to be told that they have to save. Most people would like to take full control over what they do with their money and try and avoid any imposed system which is laid down by a government, even if it's in their best interests. So as we look at distribution costs, and we look at distribution systems, I will share with you some of the developments which are taking place in other parts of the world. I'm not implying that that will develop here, but I think it does throw down the gauntlet for those of us involved in the mutual fund and unit trust industry. The third area is performance. And I'll give you a statistic in the United States. There are more mutual funds available to the general public than there are companies listed on the stock exchanges of the United States. Which, if you think about it for a minute, doesn't make a lot of sense, does it? This is where the industry has arrived at, through competition, through opportunity, through choice. Investors are overwhelmed by the types of funds that they are being offered. They have to make decisions on which market, which currency, which part of the market. Is it small cap? Is it medium cap? Is it large cap? Is it value? Is it growth? Is it manager A or is it manager B? At the end of this whole process, we are leaving our clients with a view that most fund managers underperform the market in the United States. In fact, 60%, according to some studies, underperform the market. Now, there are many reasons for this, but the impression that we're leaving on our clients is not a good one. We really need to focus on performance excellence. And when we talk about performance, it's not just about the performance of a fund over 3 or 12 months. It's about setting expectations correctly. And this is where you come in. Talking with your clients regularly. It's not like selling a life insurance policy, which has a 25-year term structure, where the known return at the end of that period, perhaps not guaranteed, but is pretty much stable. With a mutual fund, with a unit trust, your products are priced every day in the market. You are operating with utmost transparency. We as fund managers are looking at our performance on a minute-by-minute basis, every day of the week. We are charging our clients every minute of the day, 7 days a week, 52 weeks a year. It's a very transparent environment we're operating in. So, the focus on performance is very important, but again it comes back to one of the points that your President raised at the outset. It's about setting expectations. It's about your investors really understanding what the objectives are and how that is going to be achieved. It's no question that if you save regularly, you get the benefit of dollar cost averaging. Everybody knows that. But it's also no question that the ultimate return you get from an investment depends on how much you pay for it at the beginning. We know that. So there will be times when there are good points of entry to different asset classes. Perhaps you could argue that today in this region in terms of equity markets. But getting your clients to understand the situation is critical. At the end of the day, unit trust investing, retirement investing, long-term investing is all about taking personal responsibility. There is no substitute for that. So when my clients ask me, what is the best investment for me? There is no right answer to that question. I can't tell them what's right for them. I can help them identify their objectives. I can help them understand the choices. I can help them appreciate the risks that are involved. But my responsibility is to ensure that they take the decision, because they have to be happy with it. When they go home, when they sleep at night, when they face the rest of their family, they have to believe they have made a decision and they have made a good decision. They have to know where to go to for investment advice. They have to know where the information is. They have to know who to call when they need assistance in understanding what's going on. But at the end of the day, they have to make the decision. And I think that's the difficulty we all face, particularly when we hear about government grant schemes to launch community-wide retirement programs. It all sounds great. Everybody will save, everyone will benefit. The government doesn't have to pay too much long-term in their pension requirements and gets them off the hook as well. It all sounds very great and grand. But at the end of the day, where we sit in this scheme of things is we need to make sure that the individuals take responsibility for their actions. Because what you can't afford to happen is failure, unanticipated outcomes, unanticipated returns, where the individual feels helpless, they don't feel responsible, where they feel they have made a decision based on someone else's views. The fourth area I'd like to cover as well is linked to the third topic of performance. The fourth area is that of passive investment. Increasingly we're seeing the growth in assets invested passively. Passive investment means no active return. The investment manager is aiming to deliver an investment return in line with the market, as indicated by a market index. This is a growing trend. It's been particularly strong since the financial crisis. In the eyes of the client, of the investor, what are the benefits? Well, the expected outcome is guaranteed. You know you will get a performance in line with the market. So your decision is easier. You've still got to decide which asset class you want to invest in. You've still got to understand the risks of the market. But you've eliminated a whole set of other questions that you now no longer need to answer. Who should manage the money? What's the strategy? How do I think about rebalancing? All of those questions go, because all I do is buy the market. Second area, which is very appealing to many investors, is the costs are lower. You're basically buying into a systematic way of building a portfolio which benefits from enormous economies of scale, and therefore the management fees are a lot lower. So these two issues relate to the product and how the product looks to the client. And I think they are a threat to the unit trust industry. No doubt you will have index funds in your armory, in your range of products. No doubt that investors will still need advice and hand-holding. But the third feature of this product is where the threat comes from. Because ETFs are not just about passive investment, they're also about distribution. They're also about the way in which your clients access the opportunity. ETFs are listed on stock exchanges. They are sold through stockbrokers, remisers. They are sold through banking services. They are sold without advice. They are sold very cheaply. They are sold on commissions, which are the same commissions that apply to individual stocks that people buy on the stock market. They look like individual stocks. They're governed by the same rules that govern stocks. So you have a different set of regulatory requirements, which quite frankly often are a lot less onerous than we face in our industry. And I think this is where the challenge comes from. So no doubt your clients have room for passive investment in their overall outlook and portfolios. And typically what we're seeing in developed markets is investors will allocate a certain amount to an ETF or collection of ETFs and passive investment, taking less risk, if you like. They have an overall risk budget They'll take less risk with the ETFs because it's a known outcome, and they'll spend their risk budget on actively managed unit trusts and mutual funds. And this is how people are thinking now in Europe, in parts of Asia, certainly in Japan, and certainly in the United States and Canada. So this is a growing trend. It's a trend which we need to understand, and it's something we need to think about as we emphasize what it is we stand for. If we're offering active investment management, what does that mean? What does it mean to the client? Why is it useful to a client? If you're investing in your retirement fund, 200 basis points, 2% outperformance over 35 years is very valuable, extremely valuable. If you think about that in terms of number of additional years that you have on retirement, in terms of being able to satisfy yourself for replacing your income that you used to have, that 2% per year for 35 years is very, very significant. So we need to start thinking about these things. What does active management mean for the retiree? I was talking just before the conference began on the EPF and the sort of average retirement age and the amount of money that you retire with, roughly. And I think the numbers that were suggested were somewhere around 15 or 17 years if you're on half salary. That's not very long if you think about longevity and its extending. The other aspect, of course, with retirement saving and the implications for the individual is even if you have enough money saved to satisfy your requirements until your very last day, living off savings is torture. Knowing that every ringgit, every dollar that you spend cannot be replaced is very difficult to deal with psychologically, very difficult indeed. And as governments around the world shift the responsibility from themselves, from the companies, to the individual, they're asking all of us to cope with that reality, that we need to think about living off savings. So, think about active management, think about its role within a client's portfolio, think about what that extra 200 basis points per annum means over 35 years, and how it complements and helps individuals satisfy their retirement needs. The last area, I think, is what you are all about, and I think, again, speaking frankly, I don't think it's well addressed in our industry. You're representing unit trusts, but our industry goes well beyond that. It goes into private banking, as we know, it goes into retail banking, it goes into insurance. I'll give you a couple of examples. Private banks, as the market expands, they go on typically in Hong Kong and Singapore, they go on a recruitment frenzy. They